do you know the basics of financial planning so that when you are going through with the client, it's very natural to pull a tool out of that tool belt. It's very natural to say, oh, you have a debt question? Here's how you answer that. Here's the solution to that debt question. Oh, you need an emergency fund? Here's the solution to that. Okay. You want a budget put in place? Great. So I was training, I think it was Tuesday night up to my base shop, and I was talking to them about how in this last like week or so, I've written like, I don't know, let's see, 7, 8, 9, 10, 11, 12, who else? 13 policies in the last like week or so. And I was saying how the all the Sean said I'm a slacker. But all of the clients were very different. All of the clients were very different. So one was referred to me, they said, oh, he got an inheritance from his grandparents. He needs to know what to do. No one's helping him. Great. This is a single 39-year-old male. Okay, it makes about 80,000 a year. The other one was a young family, a young husband and wife who reached out to me asking about how to budget. That was their question. I want to learn how to budget. But they had a little girl, I think a like 5-year-old girl, one daughter. And then so that was that family. Then the next one was a husband and wife who have a business that's scaling rapidly. They have an electrician business that's just went over $1.5 million in revenue. And they have 5 kids. They have 5 kids. One had old whole life policies. Some had VULs that they had just bought. Some had rollovers of 401ks and old 401k and an old IRA that I rolled over. Okay. And one said they didn't have any money to save, but I found them $2,000 a month. Okay. So every single person I sat down with was very different clients, single, married, whatever. But the thing is, like every single person, I started off exactly the same. Okay. Whether they said, I want to roll over my inheritance. I want one of those tax-free things that my financial planner doesn't know how to do, that you did for my friend, which was IUL. Another was, again, I want a budget in place because we have no money. That's when I found $2,000 a month. And we ended up doing a bunch of stuff for them. So, but how I started off was like, well, let me show you a little bit more about who we are and what we do. So I just want to tell you that because every presentation, whatever's thrown at you, they might say, I have a Jigger Jagger 5827. Can you do those? It doesn't matter what they throw at you and you have no idea what they're talking about. And you just say, okay, that sounds good. We can definitely look at that. But let me just kind of start off with showing you who we are and what we do. And then you start into your step 1. Okay. So I just want to share that with you. Whenever you're intimidated as a field trainer of like, well, they have this inheritance, or well, they have 7 kids, or well, they have VULs and IULs and whole lives and all this stuff. All of it is, we're going to take a full snapshot of where you're at, what your goals and dreams are, and then we're going to show you the best way to reach them. Does that make sense? So let's start off with who we are, what we do. So it doesn't matter. Like they could say, tell me more about your tax-free IULs. I want to know about the LERPs, or I want to know about the 7702 plans, or I want to know about infinite banking, or I want to know about whatever dumb TikTok name they heard on, about tax-free vehicles. Whatever they tell you, great. We can definitely go over that. I'm excited to talk to you guys about that, but let's at least kind of first get to know each other. Let me kind of introduce who we are and what we do. And then you go into step 1, and it leads into taking an F&A. Then you take your F&A and you do a very good job. And I'll teach you exactly how to do that very quickly as well too. But once you do, then you can come back to someone like Olivia and be like, oh my gosh, they have the Jigger Jagger 558 or whatever it is, right? I've never heard of that before. And then she can say, okay, let's go see what's best for this client, and they can help you. So you don't have to be intimidated by any of those things, okay? I just want you to know that. So, and when I was in your shoes where I was scared of those questions or advanced products or whatever, then I just want to remind myself, like, they're going to be better off because I talk to them. I have something to offer them. I'm going to help them. And I would just kind of take it one step at a time. Okay. And then when they did have those things, I'd say, do you have a statement on that? and I would bring it back to my SMDs or my more qualified licensed, whatever. Okay. All right. So let's start off with the basics today. And I think that you guys are going to learn a ton still, even though it is kind of basic. All right. So I'm going to bring this up. Here we go. Sorry, I have a little cold and I'm sore throat. Okay. So this is the 6 steps of financial independence. Let me ask you guys, raise your hand. I want to see if you guys have seen this before. Let me see. Raise your hand if you guys have seen this before. Oh my gosh, there's a lot of heads shaking no that they haven't. Okay, or some version of it, even if it's not these colors. You might have seen it in a BPM presentation, a PowerPoint. Okay, so there's a lot of people that are like, no. Okay, good. So I'm glad we're starting with this, Shawnee. All right, so this is why I wanted you guys to know. There's probably a lot of newly licensed people too on, so I'm glad we're starting here. But this is the 6 steps to financial independence. Okay. Now, just so you know, like you could come across someone that you know from church and they make a ton of money and they have the nice houses and the nice cars, but most of the time, people don't have all 6 of these in place. They may have 1 or 2, maybe 3, but it's very, very rare that they have all 6. And it's so rare, in fact, that I've been doing this 25 years. I have done like a bazillion step 1s and step 4s and F&As, and only one time does someone have all 6 in place. One time in 25 years. How about you, Sean? How many times have you run across it when they had everything?
Oh yeah, 3 or 4.
3 or 4, he said. He does a lot more step 4s than I do. Okay. But that's crazy, right? So that means that almost everybody, not just that but everybody that's out there in the world needs 1 or more of the things that we do. So this is what we do for families, these 6 steps. So cash flow is basically like helping them to create more discretionary income, lowering their expenses, those types of things. And then emergency fund, right? Making sure that they have an emergency fund so they're not going back into debt if something happens. I'm going to teach you how to do that. I'll teach you how to do all these things today. Okay, debt management, how to get out of debt, how to eliminate debt the fastest possible way. Proper protection, again, making sure they have the right insurance, the best insurance for their goals and needs and their families, and protecting their assets and making sure their loved ones are taken care of. But again, for the least amount of money. It's just insurance. We want to make sure that we're not overspending, okay? And then building wealth. Of course, that's now the long-term savings. The emergency fund, those are like short-term savings. Building wealth, that's the long-term savings. And then sometimes they'll have some intermediate goals, like midterm goals, and we'll talk about that too. And then preserving wealth, that's like your estate plans, leaving a legacy for the family, meaning estate, trusts, wills, those types of things. Okay. Now, Neil, if you could keep watching the chat, I'm going to take this down for a second. Okay. So what I want to do is I want to teach you how I address each of these needs so that when you guys watch me and Sean in like field training mode, like I'm field training you, or you're watching me do a presentation and interact with the client, and I bring one of these tools out based on their needs. Am I going to go over all 6 steps? Like if they have plenty of cash flow, do I need to address that? Not necessarily. Maybe I'll try to recruit them, but that's different. If they have way too much in the emergency fund, do I need to talk about how much more they need to save and where to put it? I don't need to pull out that tool belt. If they already have all their insurance needs met, do I need to address that? Maybe if it's not the right insurance need, but it just depends. Every family is different, and I'm going to pull out these tools as I need them. So yes, you need to know the presentations, but you also need to know how to address their needs. Does that make sense to everybody? So let me just go through the chat because I see a bunch of stuff. Okay, someone said, what license do you need to have to put a trust in place? There is no license because you are not doing that trust. That is someone that is an attorney. An estate planning attorney will do that. You're only going to address if there's a need for them to visit with an estate planning attorney and put one in place. Okay, so that you will not be doing that. Okay, so there are a lot of questions about emergency funds and all right.
Did
Good.
you want me to just hold off on those until we kind of go through it?
If there's anything that comes up that you think I should address as we're going, definitely tell me.
Okay, cool.
Okay, so let's go through this. All right. I'll just tell you, I only use 100%. The only thing I use when I'm presenting, besides my iPad and my little finger on the whiteboard once in a while, and you'll see that, is those flip charts, those 5 flip charts, right? Step 1, step 2, step 3 is a PowerPoint, step 4 and step 5. So just, I don't do anything else. I don't show anything else. There's nothing I add. And you know, your field trainers might be fancy pants and show like all kinds of cool things. First of all, make sure it's compliant before you do that. But also, for me, I want it to be super understandable for the prospect, but also duplicatable for my trainee. So that's the reason I have those flip charts that are like 1 page each. You know, I think that I have not just the tools I'm going to share with you, but I have a lot of tools. I have all these wealth management strategies. I have the e-money platform. I have all these cool like active management stuff, the Trans One platform, like the Fidelity, FMAX. I have all kinds of cool stuff, right? But I don't have to sound like this super, I'm so awesome financial planner. I just have to be relatable, and the client knows I know what I'm talking about. In fact, I'll tell you, Damon and Heidi, one of the clients, the ones with the little 5-year-old daughter, they had come to me for budget stuff, right? And I just did their insurance plan and their savings plan and some other things, emergency fund, all this stuff. But you know what Heidi said after my first appointment, where I did step 1 and step 4 and took an FNA? She goes, you know what? We've heard all of these things, but this is the first time I understood it. The way you explained it, it all came together. That's what I want. That's what I want. I want my clients to feel very, very confident in what we're talking about. The other one, Damon, he was saying, Jamie, I went and I talked to 4. I just want you to know, I talked to 4 different financial advisors. I called 4 different people, and you're the only one who just talked to me, not at me. And he's like, then I looked at your social media and I saw that you're all about faith and family first, and I loved you. Perfect. Great. My business card's out there too. Then it works, right? That's what I use social media for, is for credibility. All right. So let's get into this. Let's first talk about the first one, which is cash flow. Neil, do you have the 50 ways to save $50? Can you find that, if at all possible?
Yes, I do. I have the Happy and Strong version, which is fine.
That's fine.
Cool.
Yeah, that's fine. I want you to show you this. So, and I'm going to let Sean come in too. So we'll just talk about cash flow really quick. So that's when they say, can you help me with the budget? Or I will be going through and taking the FNA, and there's a part in the FNA when you're asking their expenses. Does that make sense? So tell me about your expenses. Tell me about, what do you pay for mortgage? What do you pay for, auto insurance? What do you pay for gas? What do you pay for whatever, right? And we're getting all of these things. And then let's say you add up all their expenses and it's 4,000. And then you say, what's your take home? And it's 4,000, right? And they have very tight budget. Okay. So a budget is something I will typically talk about almost in every appointment. For example, one of those clients, they're like, we don't know how much, we're not saving anything. And then I do their budget and they have $2,000 extra going somewhere. In the back of my mind, I'm like, someone has a habit. Someone has something. Someone has something going on, right? Someone's hiding something, right? But a lot of times it's just because they haven't looked at it. So what I typically will recommend on most, after I've done step 1 and step 4 and taken an FNA, I'll say, I got some homework for you. Okay. Here's what I want you to do. If they have a tendency to spend a lot of cash,
Take Amazon off your phone.
Sean said, take Amazon off your phone, right? But if they have a tendency to carry a lot of cash and spend cash, I'm like, I'm going to recommend that you use a debit card. So this can all be tracked. Okay. And or I'll ask the question, do you use a credit card to pay your bills? Do you use, because some people do, I tend to, because I pay them off every month and I get the points, or a debit card, right? And say, okay, so what I want you to do is I want you to go back through 3 months at least of those statements of that debit card. And then I want you to fill out your own F&A on this portion of where this money is going and get it narrowed down. And this is only for people that are really off on their budget or they're asking for budget. If they say, hey, they know all their numbers and they have $800 discretionary income and they say, I want to save 500, that all makes sense to me. But they're now the ones that don't know where their money is going and they need you to help them with budgeting. So then I say, okay, I need you to do a little bit better job of tracking where all this money is going. So again, go back through 3 months, average what you're spending on Amazon, average what you're spending on Starbucks, right? And then I want you to figure out where this 2,000 is going. And then I want you to be able to tell me for sure how much you can save. Okay. And so that's where we'll start on budgeting. So would you want to add some stuff to that?
Add some stuff to it?
Yeah.
Not really.
No. Okay. Well, like I said, what I'll do is I will typically help them create a budget with the F&A. Now, if they are tight on their budget and there's a lot of miscellaneous expenses that can be cut down, I'll ask them. So, which one of these do you think that you would be able to cut back a little bit on to free up some money for your dreams, your family, and for your little kids? Sometimes you have to ask a question like that. Is Disney Plus and Netflix more important than your kids' college education? Or, sometimes. But a lot of times it's just helping them to get organized on that. And if there's free apps out there that you like to recommend for them to track all of it, you can. A lot of times I'll just say, are you good with Excel? If not, just write it on a legal pad. You know what I mean? Just write it out and figure out where all your money is going. And first is identifying how much is coming in and how much is going out. The other thing,
I generally ask them, like if they have 2,000 discretionary, like Jamie's talking about, I'll immediately ask them, are you guys tracking any of this? Do you know where that money's going? Or is it just because you don't have it allocated to anything else that it's just kind of going to frivolous things? And if so, would you rather set something up automatically to go towards the important things like retirement or school for their kids or whatever they've told me is important? And if so, how much would you be comfortable with starting to put away out of that 2,000? So I use that as kind of my starting point and starting the discussion of what they're going to put away.
Okay. Another thing you could do is you could ask them, do you get a big tax refund do you get a big return on your taxes? And if they do, you can recommend that they talk to their accountant to possibly change their deductions so that instead of getting that big amount at the, refund, that they can get a little bit more monthly in their discretionary income. That's one way. Now, you're not going to make that recommendation. You're not an accountant, but you can have them talk to their accountant about that. And then I usually will say, let me give you this fun little thing. It's called 50 Ways to Save $50. Did you find that, Neil? Can you pull it up? This is something I typically will give to my clients. It's just a fun little thing. You want to pull it up?
Yeah.
I don't have it in here.
Can you see it?
It's coming. Looks like something's happening. There we go. 50 ways to save $50. And you could make your own version of this. But let's see. It says avoid prepackaged processed food. Join a warehouse club like Costco and buy bulk. Pack a lunch for work, all of these things.
Plan your meals, stick to a list.
Plan your meals, stick to a list at the grocery store, wash your own car, right? Use the quick change oil loop service instead of full service, call your cell phone bill. Anyways, this is just a cute little thing. You can take it down, Neil. You can link this in the chat so that they have it. But you can offer like little solutions like that as well. Okay. So and then the other thing is if they are really tight on their budget, best way that you can help them increase their income is what? Recruit them. Like offer them the opportunity. So that's just a couple ideas on cash flow. This is a little thing. But again, I would say probably half the time, maybe a little less than half the time, I'm giving them that homework to at least create their budget. Okay. It's just a homework assignment. It's not like something I'm going to do with them.
Yeah, we're not spending hours.
Yeah, I'm not doing that with them. That's me telling them how to do it. Okay, so next one is debt. Okay, now this one is going to be a certain percentage of your clients. Okay, so
Jasmine said coupons.
Jasmine Jasmine's a coupon addict. Don't get her. Don't talk to her about that. She's going to get you into her coupon cult. Okay. Okay, but debt. Now, debt's a big one that you guys are going to go over quite a bit with your people. So, if they have debt, again, I'm taking the FNA, and sometimes they'll tell me that's important to them. Sometimes they won't. But when I take the FNA and I'm gathering information, I gather all of their debt. Okay, so here's how it looks. I'm asking, like, tell me about your debt. Do you have credit card debt? What kind of debt is it? Okay, I have credit card debt, about 50,000. Okay, then let's break it down. Card number one is how I write it. Card number one. Is that a Visa? What, MasterCard? What is it? It's a Visa. Okay. And so when you're doing the debt stuff, you need information. You need how much is the balance of the debt? Like, how much is on that Visa? 2,500. Okay. What's the interest rate? Oh, I think it's 18.5, something like that, 18 something. Okay. How much do you normally pay? Do you normally pay the minimums? What do you normally pay? I normally pay $50. Great. Do you know the minimums? I think the minimum's 34. Great. How much is the high credit limit on that one? I don't know. I think it's 4,000. So these are the things that you need to give advice on the debt. You need to know how much they owe. Sometimes you're going to need to know the high credit limit, and I'll tell you why in a second. You need to know the interest rate that they're paying, and you need to know what they normally pay and their minimums. Does that make sense? Okay. Then, Kate, what about card number two? Oh, card number two, it's a Target card. Okay. How much is your interest rate? Blah, 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 blah. 27%. Oh my gosh. Okay. How much do you owe? And you get all of their debt, whether that be student loans, personal loans, department store cards. They finance their mattress that they bought, whatever. Does that make sense? Okay. Now, there's two different versions of doing this. There's called debt snowballing and debt avalanching. Have you guys heard of these things? Put in the chat if you've heard of these things, because I want to know kind of what experience you have with this. Someone asked if I take the FNA after step one. No, I go step one, ask them, are you interested in the business or the financial education or both? They say both, and I say, where do you want to start? If they say business, I start with step two. If they say financial education, I go to step four. The FNA is taken immediately after I do step four. It just goes right into it. Like, I'll do the financial education, and then I'll just start gathering information. Okay. Debt stacking. Yes, that's another way to say it. Debt stacking, debt snowballing, debt avalanching. Okay. So I'll just tell you what it all is. If you guys don't, if you guys haven't heard of this. So basically what you do is you get all this information that I just told you. Okay. Now remember, when you make a recommendation, let's say they can save $800 a month. Some of that money goes to short term. Some of that money possibly could go to midterm goals, and some of that money could go to long-term goals. Okay. Short term, because there's usually immediate needs, like they need life insurance, they need to get rid of their debt, and they need emergency funds. Those are typically the short-term needs. So of the money that they're applying to short term, how much can be applied towards debt? So let's say they're already, with all that they're paying with their debt, all that they're paying with their debt is already adds up to $500 a month. Okay, so they have 500, and now they want to put an extra 200 towards debt, towards short term or something. Now you have $700. Okay, or whatever it is that they can apply towards their debt. You guys following me so far? Am I explaining it correctly? Okay, I just can get confusing real fast. I just want to make sure that you guys are getting it. Okay, so of the money that you're going to allocate towards the debt.
It's harder when you're not writing it out. Like,
yeah. Okay, so you want to help them have a systematic way to pay off that debt that they feel comfortable and they understand. Okay. So debt snowballing, debt avalanching, debt stacking, It's all very, very similar. Okay, but what it means is that you're taking the amount of money, let's say it's $700, and that snowballing is that you pick a card, typically the lowest amount that they owe. Like let's say they owe, you know, $500 on their Target card at 26%, and the other ones are way higher. Well, it's easier to pay that $500 off the Target fast. So that's debt snowballing, where you put all the minimums on all the cards, and then you take the balance of that $700 and you pay it on that Target card until that Target card's paid off. And then you go to the next highest balance, to the next highest balance. And this way works well because psychologically they have a win. They're like, oh, I'm getting my debt paid off. I have one of my cards paid off. I'm cutting it up, right? So that's called debt snowballing. Okay. Debt avalanching is the way I prefer, but some clients, they're just really bad at this. And they're not looking at the numbers. So snowballing is easier for them to actually find results. Okay. So avalanching works like this. This is how I typically do it with my client. It goes like this. You figure out all the credit cards. Well, I guess where to start is this. Well, let me tell you avalanching first, because I don't want to backtrack. Okay. So you figure out which interest rate is the highest interest rate card. Let's say that's that Visa at 26%. That's really ridiculous. Okay. So you would pay with the $700, you'd pay minimums on all the credit cards. And then whatever the balance of the 700 is, you're paying it towards the highest interest rate card. Okay. Once that card is paid off, you take whatever you're paying on that and apply it to the next highest interest rate, and to the next highest interest rate, and to the next highest interest rate, until you finally only have one debt left, one card left, and you're paying $700. Doing it this way and applying the majority of the money to the highest interest rate card and getting rid of the high interest rates faster will cut the time down much faster and less compound interest you're paying overall. Right?
Yeah.
You want to add to that?
No, that's it.
Okay.
You're explaining everything. So
Okay, I'm gonna let you
Ditto.
start next time. Okay, so one other thing that I usually do is, let's say they have something that's like a really low interest rate. Let's say they have on their MasterCard a 1%. That's good for another year. Okay. And let's say they owe $2,000 on that MasterCard. I say, what's the high credit limit on that MasterCard? I think I'm like almost at the max. I think it's only 2,500. I'm like, okay, your homework assignment, call the MasterCard. By the way, call all of those Visas, right? And ask them if there's any special offers. Like, is there something I can maybe get 0% on balance transfers? Or like that Visa that's at 1%, that MasterCard that's at 1%, can I raise my limit from that 2,500? What's the highest limit I can get raised right now? And a lot of times if you don't have late payments, they'll let you raise it. So here's what we would do. If you were my client, I'd say, okay, of all these cards, here's what I want you to do. I want you to call the Visa and the MasterCard, say, is there any special offers? On the 1%, see if you can increase your credit limit. Then what we're going to do is we're going to take that Visa at 1%. We're going to pay off that Target card at 26%. We're going to pay off the Ulta card that you did. We're going to pay off the mattress that you're paying, this high interest rate. And we're going to try to move the high interest rate debt down to lower interest rates. Does that make sense? And now this is all homework that they do. If they don't do it, that's on them. Does that make sense? You're just showing them how. You're teaching them how. Then when you get back for your second appointment or your step 5, so what'd you find out? Oh, I know that my other card, I have 0% till next May. Sweet. Were they able to raise it? No. Okay, well, we know we need to get that thing paid off by May. So pay whatever you have to pay to get that thing paid off by May. Then we're going to do minimums on everything else. Then the difference we're going to apply towards your stuff. Okay. And when we go into the field training stuff, you guys, I'll show you in step 5 where I make this recommendation, and it's very fast. It's very, very easy. Okay. Any questions on that? Did any questions come up?
I will say, while you guys are writing questions between the two, like people ask which one's better. Sometimes paying off the smaller amount is faster. Sometimes paying the higher interest is faster. If you roll it out, like some of those companies that people are putting in the chat, you can go on their website and it'll actually show you exactly which one's faster.
Yeah.
But I can tell you psychologically, the one that works best for most people is paying the smaller cards first.
Yeah.
The smaller amounts
Because they have
first,
that win.
because it gives them that win. They see one of them getting paid off. And then if they take that, let's say it was $100 they were paying on that one, or $50 or whatever, and put that towards the other cards, like that starts that habit and it builds up. They're more likely to do it with the other cards. Even if it maybe won't pay it off as fast as doing it the other way.
Yeah.
It'll keep them most likely continuing to do it.
Yeah.
Yeah.
Okay. All right.
Do you ever, one question came up multiple times. It was, do you ever refer them to a debt consolidation company?
To be honest, I never have. They never have, because most of the debt consolidation companies, it ruins their credit. You know what I mean?
Ruins their credit. It has to be to the point where they're just spinning their wheels.
And they're like almost
Like
in bankruptcy.
paying interest, and they're not paying it down at all. That's when I refer it. But if they can pay it down, typically they're better off. And if they can't, then yeah, we recommend them.
Someone says, is it true that you can contact the credit card company and request the interest rate to be lowered?
Yes.
Yeah, you can ask for whatever you want. And if you've never made a late payment, a lot of times they want those balance transfers. They want to have that money that they're making the money on. So a lot of times it can happen. Okay. All right. Anything else, Neil? Can we move on?
Yeah, that was it. Oh, there was one random question. It says, can you take a HELOC to pay those cards?
You can. And that, again, that's you're just moving it over. If you can get a really, really low interest HELOC, possibly. Sometimes they're a member of a credit union and they can get a really low interest rate personal loan. Again, if we can move stuff down to a lower interest rate, great. But again, if it's a really long HELOC and just getting them into more debt, I'd rather just see them on a very systematic way to snowball this thing gone. You agree with that?
Yeah, like I said, it builds up the habits too, better habits. So it's helping them set themselves up to be able to save more money down the road.
It says, what if a client wants to take out money from their 401k or IRA to pay off a large debt? That would probably be...
Stay away from that.
Yeah, I would probably stay away from making any recommendations like that, because they're going to have tax ramifications for taking it out early. You know what I mean? So...
Well, even if they're probably talking about taking loans against their 401ks at a lower interest and all that stuff. Here's the thing. If you get licensed, especially with the securities license, you want to stay as far away as possible, as recommending people take money out of their house, out of their 401ks, out of retirement accounts to pay off anything. It's just a gray area that could get you in trouble with your license. I would recommend staying far away from those ideas.
Yeah.
When you're talking to your clients about it.
And I don't like anything that's going to get them, more in debt. so trading debt to debt is typically not great, unless, again, we're moving stuff down to lower interest rates for less time. Okay. All right. What's next? It's emergency funds, right? Do you want to start this one? You want to start this one?
On what?
Emergency funds.
I was reading that. Sorry. Okay. For emergency funds, people ask us all the time, what do you use?
Okay.
For the longest time, I've been using TransAlpha for that, even when the interest rates were low. And right now, the TransAlpha the cash account, I forget what it's called. I think it's called cash balance or something like that. It's a money market. It's paying 4.25 right now. It got as high as 5%. And the reason I use it more than anything is less for the interest. I mean, it's nice that it's earning interest, because most people are just earning nothing in their checking account, or it's just sitting somewhere, not earning much of anything. But the reason I like it more than even a savings account. So let's say they have a savings account at their bank that pays 4%, and they could get in TransAlpha at 4%. I would still rather they be in TransAlpha so that they don't have immediate access to that money. The challenge with savings accounts nowadays at their bank is that you can go on your phone. It doesn't matter. Like, I've got 5 different accounts with my bank, and I can go on my Chase app and instantly have as much money as I want in any of those other accounts.
Yeah.
So if you have bad habits with money, that's a bad way to try and save money. So if you separate it and use TransAlpha, it takes you 3 to 5 days to get that money. And so that separation stops people from their bad habits of emotional buys, which is where most people mess themselves up. And so if you set it up in that account, it gives that separation. Now, the only challenge with TransAlpha is you need a 65 to set it up for people. So like I personally have a Series 65.
That's the license. So it's in the chat. Says someone, what license do you need? You need
Yeah.
a Series 65.
You use a Series 65 for it. So if you don't have a Series 65, you need to refer to somebody that does. And I can tell you, I have my Series 65, but I don't set these up for my clients. I actually refer, like Jack Tucker sets up all of the ones that I have. That's Betterment.
Yeah, that's Betterment. So
Someone says, how about Betterment? TransAlpha is Betterment.
Yeah.
They're using that platform, but it's a branded Transamerica platform through Betterment that we have called, that's what TransAlpha is. So, but I have it set up where Jack Tucker sets up all of those accounts for my clients. And I refer them to him. So he sets it up. The way they set it up is they get sent a link to set up the account. And then they basically set it up themselves, transfer their money, link it to the
someone in your upline probably has a 65.
Yeah.
And that's who would do it. Okay. So here's someone said I use Kim Jones. Some people probably use Michael Coleman or whatever, right?
Now, one thing on that is that if you're not licensed, you can't talk about the account, money markets, things like that. Like you can't be like, oh man, there's this great money market account. It's paying 4% or whatever. You can say there's a great account for emergencies. I can, we can set up a time with Kim where he can explain it and talk about it. So that's how you have to talk about it if you're not licensed, unless you have one. If you have one, then you can say, oh man, I've got this great account. It's, it's called a TransAlpha account through this company called Betterment.
Okay.
It's paying me 4% right now. It's liquid. It's awesome. You should check this out. And then you set up a
I just wanted to say a couple of things about emergency funds. So again, so when I'm going over the F&A and I'm explaining these things, I say typically, this is what I say. Typically, we recommend that you have 3 to 6 months worth of your expenses or your income. Okay. Now, you have a great job. You've been there 10 years. You have security. You don't have any kids yet. You don't have a mortgage. You have a bunch of money in the bank. Like you're fine. You know what I'm saying? But if someone has like commission only, they're laid off pretty often. It's a very unpredictable, work. They have a bunch of kids and a mortgage and debt. Then they need to be on the very high end of that 6 months or more. Does that make sense? So again, you have to know your client. So one of the clients that I sat down with this week had way too much in his checking account. Okay. He had way too much in his checking account. He's like, I want to do it. I didn't know what to do with it. And I said, well, here's what we can do. Well, you already have, you're earning 0% at your checking account. There's a lot of things that I recommend that are going to do better than 0%. It's in the market if it's in a money market. So there is a possibility of loss. So you want to be, super conservative. So I don't mind that you have this much in the savings account. But I do think we should move some of it into something better. It could be in money markets. It could be we have a robo advisor called TransAlpha that a lot of people are liking right now. It's hooked to your checking account. So if you needed the money, you just make a phone call and it transfers right into your checking account. There's also the Wealthscape, you guys, which is the new Fidelity money market that earns 4%. So there's lots of different options on this. But so a lot of times what I'll ask them is like, do you have access to something better? Because all I want is to make sure it's there when you need it. And so sometimes they have like a parent that was in the Navy and they have the Naval Federal Credit Union and they have an emergency fund that they could put it there and it's separate than their Chase Bank account and it's earning 4%, and they really like it there. That's great. Does it make sense? So again, when you're asking these questions of what do they have and what do they have access to when you're gathering the FNA, a lot of times I don't even move the money, the emergency fund. I just make sure they have the right amount and it's there when they need it. Does that make sense? Cool. People are saying how awesome Tracy is. Tracy is awesome. Okay, so I think that's good on emergency fund. Yes.
Someone had a question with money designated to short thing. With money designated as short term, how do you split between emergency fund and more to debt? 50-50?
Oh, no, it depends on the goals. It depends on the goals. I'll show you that when I'm making recommendations. Okay. Okay. So again, forget what they have access to. Someone's talking about Texas residents can earn blah, blah, blah. Great. If they have that, awesome. I don't need to manage their emergency fund, to be honest. Okay.
And this,
So-
I mean, it changes quarter to quarter. It's different what's out there.
Yep. Okay. You just want to make sure that there's money there. And again, keep in mind they need liquid money, and they need, depending on, again, 3 to 6 months at least, but it really depends on their I guess risk tolerance of short term.
Yeah, but the most important thing is that it's separated from instant access in their checking and savings.
I don't want it to be like, oh, I have this much in my emergency, let's go to Vegas. Like I don't want it to be that accessible or that like tempting, I guess. So that's a good point. All right, what's next? Insurance. Okay, so insurance, this is going to come up quite often, especially if they already have insurance. Like let's say they have a term policy. I think most of the clients that I did this week had something. They had term policies, they had whole lives, they had VULs even. And so this is what I have to, but this is my tool and my tool belt that I have to pull out. So I'm going to pull up what I show them. I'll say, okay, let me just give you a little brief education on insurance. Well, there's term and there's permanent. Okay. Permanent insurance is like your whole lives and universal and VULs and stuff. And term is temporary. It's like renting versus owning. Okay. Term can be less money, obviously, but that's because it's not there when you actually die, right? Then I'll ask the client, Damon, what do you think? Every one of these clients, I asked them this question. I said, what do you think is the like the average payout, like or what the percentage of the payout is of term insurance? Like what percentage of term insurance actually pays out at death when you die? And they'll say typically something around 10%. And I'll say, well, actually, no, it's about 1%. You can Google it. Only about 1% actually pays out. And that's because it's only for 20 years or 30 years or 15 years and not when you actually die, usually of old age, much, much later than that. Does that make sense? So term has its place, but, maybe, and I'll say maybe for like, I don't know, NBC's late night talk show host. Who is it? I don't know if it's Jimmy Fallon or whoever that is, right? They may have a 5-year contract to be the late night talk show host, and NBC then buys a 5-year term policy. So if anything happens to him, it either can replace him and find someone new or replace the income that is generated from that. Does that make sense? Or maybe a single mom or someone that's on a very, very tight budget that needs insurance but can't afford a real permanent policy, right? So then I'll say, okay, so now let's talk about permanent. And this is something that you all should like really know really well. And this is what you saw me teach when I was teaching that class for them to pass their license the other day, the tutoring class, right? So there's things called whole life, okay? And I always joke and I say, that's called whole life because you have to pay for your whole life, right? Instead of 10 years or 15 years or 20 years, it is permanent and you pay till you're 100 years old, all right? And so instead of like 20 years, 30 years, whatever, it's forever. And then I'll say, let me just back up real quick. Let me just show you how these terms actually really work. And I'll go back into term and I'll just say, okay, so there's the most popular that you've probably heard of. It's called level term. And so let's say it's a 20-year term and it's $300,000 of death benefit and it's $40 a month. And it stays $40 for every month for 20 years. And at the end of 20 years, it ends and it's gone. So it's kind of like if you don't die, you have no benefit. Like almost like auto insurance. If you don't get in a car accident, it was just wasted money. Does that make sense? But you need it just in case.
Especially with our kids.
Our teenagers. So, but here's how insurance really works. What's happening is you're you're overpaying in the early years and you're underpaying in the later years, because how insurance really works is like this. It's supposed to be like this. For that same 20 years, instead of 40, it should start off at 20 and end at 60, based purely only on your age. As you go up, insurance costs go up, period. Any kind of insurance. So on this level term that's so popular, you're overpaying in the early years to underpay in the later years. Does that make sense? Kind of, yes. Okay. Well, there's also another one, not very popular around here. It was in the Midwest. It's like a 30-year term, and people would buy a mortgage, and then they needed insurance because they have this new big mortgage, but they couldn't really afford it because they have all these new payments. So instead, it's called decreasing term. It looks like this. So it's still $40 a month, but if you died here, you'd get 300,000. If you died here, you'd only get maybe 200,000. If you died here, you may only get 150,000. If you died here, you'd only get 50,000. But your premiums are staying the same. So do you understand what's happening? You're paying the same amount of money, but for less coverage. So my point to you is
Most companies call it mortgage insurance.
Well, no, because that's different.
No, but a bunch of them call it that.
It's not the same as mortgage insurance, though.
No.
So, but decreasing term or mortgage insurance, which some people call it, but it's not that. So anyways, here's what's happening. All insurance, I just want you to understand that concept, because all insurance is kind of the same, okay? But there's the two big groups of term versus permanent, okay? So let me now show you how the permanents work. And then you'll really start to understand this. The permanent insurance, whole life, you pay till you're 100 years old. But instead of $40 a month, let's say it's $150. And some money is going towards the $300,000 death benefit, and some is going towards savings. It's called cash value. Fancy word for savings account. It only earns like 4% or maybe even less sometimes. But here's how it works. If you died here, you get 300,000. If you died here, you're going to get 300,000, but 150,000 is coming from the insurance company, and 150,000 is coming from your cash that you put in there that you're just getting back. If you died here, you're basically getting 300,000, but you're just getting your cash back, your savings portion back. So let's say if you died on these things, it's very, very, whole life is very, very rigid. It's like the dinosaur of the industry. It's such an old product. I don't like them at all. I never sell them because they're just not flexible. And I say, so if you died, you get that 300,000, but a lot of times it's you're getting money back that you put in your savings. Now, if you died, you only get 300 grand. So you don't get your savings. You understand? So let me ask you a question, Damon, Heidi. If you put your money in a bank and then when you died, the bank kept your money, is that someplace you'd want to put your money? That they keep it and don't give it to your family? That's not good. Does that make sense? And it's also not flexible on your premiums. It's not flexible on your premiums. So if you ever make like where you can't make a payment, they're going to cancel you. You no longer have insurance. There could be penalties, and then they give you your cash back. Does that make sense? So I know we're at 12 o'clock, you guys, but let's go a couple more minutes so you guys can see the rest of the insurance portion. So you say, so now there came a thing called universal life. And when you see the term universal life, it means flexible. Means flexible face amount and flexible premiums. So let's say you're putting your money in the cash value, and let's say you have your insurance, still a little bit more because it's permanent, but some money's going here, some money's going here. If you ever can't make a premium payment, the cash value just comes out and pays for itself. Does that make sense? So way more flexible. In a regular universal life, it still only earns like 4 to 6%. So not a great savings. But now there's new, more modern policies where, again, just like in the universal, you can get your face amount plus your cash at death and have the flexible premiums, but the cash value is in a better savings vehicle, like an index like an S&P 500 or even in the market so you can get better returns. So this is kind of some of the things that you probably have heard about where you can kind of have that tax-free investment. We'll talk more about that when we get there. So I'm still not going into the product recommendation. This is just if they have a whole life policy that they like, or they have an old crappy policy that they want to keep, or they have term and they seem to like term or something. And I'm just educating. You see how I just did an education? I did not push one product or the other, but I did pique their interest to know more about the tax-free vehicles. Does that make sense? So this is the tool that I have in my tool belt when I know that they have this. And I usually will typically go over this on the first appointment if they have it. So that groundwork is already set for when we go back and maybe recommend an IUL. Does that make sense? Okay, so obviously that's one piece. There's one more little piece that I want to go over when I'm talking about insurance, and that's how much insurance do you need? So I see that each of your kids has these weird amounts. One has $471,000 of coverage, one has 460, one has 520 and 32 cents. To me, it looks like some insurance agent was trying to sell the most coverage to make the most amount of money, but I don't know. I don't know the guy. And so I'll just basically so let me just go through something real quick with you, Damon and Heidi, because I think that the kids have too much coverage and you don't have enough. All right. But this is how a simple way to figure out how much insurance a family needs. It's called the DIME method. Have you heard of this? And so it's called debt, income, mortgage, and education. Okay, so you probably know you need final expenses, funeral, stuff like that, at least 15 grand there. Okay, then how much debt you have? You have about $75,000 of debt. Then there's income replacement. If something happens to you, Damon, you're the main breadwinner. You know, how much of your income does she need to still survive, pay the bills, and have the same lifestyle? And so a lot of times what they want is 10 times your income, Damon, because what this means is that if you were to die, I could take 10 times your income. Let's say you make 80,000, like 800,000. And now I can invest that money, that 800,000, and kick off an income stream to Heidi to replace your income. It never goes away again. Does that make sense? So it replaces you while you're gone. Then some people want their mortgage paid off, right? You have $200,000 left on your mortgage, right? So 800,000 here. Now you might say, well, I don't need the mortgage paid if she gets my full income, or I don't need the full income if the mortgage is paid. We need to talk about these things. And then education, some people, their kids' education is very, very, very important to them. And so let's say you're saving for your kids' education, but something happens to you and your income now is gone. So you maybe want 60, I don't know, whatever school you're thinking, whatever it is.
200,000 for community college.
Whatever that, let's say it's 60,000 a year. I don't know. But let's say you have that for until the child's 18. So what we would do is we would do a term policy rider on your permanent policy. And then when your child turns 18, we would take that off because you no longer need it. Does that make sense? Okay, everybody screenshot that. Okay, so now then we would now have a conversation. And then I would say, yeah, you don't have enough, Damon. Heidi, you have too much. And then and so like when I was going over Damon and Heidi's, like I said, now Heidi, your income's not as much, but if something were to happen to you, we need to replace like a caregiver. We need babysitters, maybe a nanny or something, and possibly grieving time for him while he's not working. So we need all of these things again. So, and so we'll talk about this. And so we'll have this conversation. So now that's all while I'm taking the FNA. So now when I go to make my recommendation, now I'm not doing all of those things every time, but again, each step that I need. So when I go to make my recommendation, I know exactly how much I'm going to sell, how much life insurance face amount, how much a month. We didn't get into step 5 and 6, which is long-term savings and estate planning. So we'll do that next time. But I want you to put in the chat if you learned something today, right? If this was helpful, if which piece was the most helpful to you possibly. Okay, so someone said I didn't quite understand the reasoning for the term rider on the education. So A lot of times we will put a term rider, or you might have heard it referred to as blending, where I might have a $500,000. Might need $1 million of insurance, but can't afford it in permanent. So I will put a 250,000 possibly of base insured to hold IUL, but then blend in term so that they have, if they die, their family gets that $1 million. It's a less expensive way to do it, blending. The other thing is also for that education piece, that's temporary. So I don't need permanent on the education piece. I need temporary. So that's term. I can either do a separate term policy for the 100,000 or the 60,000 or whatever they want for the kid's education. Maybe I would do, if the kid is 5, maybe do a 15-year term policy. Or I can add it as a term rider onto my permanent policy. And then when that child turns 18, I take it off because it's for to pay in case I die. So I'm paying for it for no reason after 18 because now I have to start funding their education as they go to school. Does that make sense? All right. So I hope that was good. I hope that you learned something today. These are all tools that should be in your tool belt. I'm going to replay this a few times between now and next Thursday. So you might want to watch it again. You might want to have your people that have full-time jobs watch it. Even part-timers can watch it, but they should just know all of these things. These are basics of financial planning, in my opinion. Again, you're not going to use all of them every time, but you should know how to have these conversations with your client. And then you should know how to do the presentation, step 1 through 5. The only other thing I was going to say is you're going to ask the question of, getting how much their expenses are, how much their take home is. And let's say that's $700. How much of that $700 do you want to start saving towards your family's goals, towards your future, towards helping you get out of debt and those things? They might say, I want to save $500. Great. Is that for long-term or is that total? And so they say, that's for my long-term. Okay, great. So now I know however much they're already paying towards their debt. Let's say it was 200 plus 700 for the long-term. Now I say, now how much do you want to save for your short-term, for emergency funds and those things? Oh, probably another 300 on top of what I'm doing. Great. So again, clarifying questions so that when you go back to do your step 5, your recommendation, or sometimes we call it the solution, offering them the solution to their goals, you know exactly what you're going to recommend. Okay.